appreciated this message from Yardi Matrix. The market is set to be tested. That's what their little subtitle was. And like, I'll be honest, like when I was thinking about this, I was like, well, what is this test? It's like, it's kind of a gauntlet. It's a test where even the people that pass the test, they're not going to come out of this unscathed. So like, we're all going to get beaten up a little bit if the economy goes down, and it's not going to be great. But we were talking about this beforehand. I think it does largely depend on where in the investment cycle you are and what kind of stage your company or your investments are in. And it also depends so much on the economy now. And that was where I kind of thought like, wow, as supply, we was reading their write-up here, is as supply wanes, man, all these demand drivers just become all the more relevant. And that's kind of what they wrote here. Is regionally, the top markets are the Northeast and Midwest, but across the country, there's just going to be those challenges that present themselves. The top line numbers for this report: 1.2% year-over-year rent growth for the nation, 0.1% month over month. Now that compares to Real Page's 0.8% rent growth, positive 1% for CoStar, a 0.4% increase for Redfin, 0.4% decrease for Apartment List. But we're all of them generally falling from like maybe a positive 1% to 0, maybe a little under for Apartment List. But this one's definitely on the higher end, but that's not to say they don't have kind of everything in order. We'll see an example in another of these reports that kind of showcase how different they can be. Regionally, again, all of the top markets in the Northeast and Midwest, as this supply winds down differently for different markets, I think that we could see vastly different rent growth patterns as the supply wave winds down. Now, I do think, though, if in the case of a recession, that difference may not be as pronounced. So if everything's all the same and suddenly now we're looking at the different supply, maybe the Midwest, the supply wave has already receded. And in the South, in a lot of these markets in the Southeast, South, Sunbelt, et cetera, they're still dealing with this elevated supply. So you could get the market divergence, but I think in the case of a recession, that market divergence may not be there because it's suddenly important to have job growth. And a lot of these oversupplied markets have a lot stronger job growth.
Yeah, and Yardi always includes a table of kind of economic leading indicators, specifically rent growth, job growth, and completions as a percentage of the total stock. And it's interesting. I mean, you have at least these completions of total stock definitely coming down from where they were 6 months ago, especially a year ago. I mean, there were a lot. Now, if you go down to the bottom, we can see a direct correlation between completions as a total stock. You can translate that into how much new supply has come on in the last 12 years and rent growth. I mean, New York City, which let's not talk about New York City because it's got its own unique drivers, a lot of large population, negative population growth. But I mean, Kansas City, 2.8% of completions as a percent of total stock, in 4.1% rent growth. Job growth coming in at 1.3, that's pretty healthy. Columbus, Ohio, similarly, maybe a little bit higher on completions of 3.5% with about 3.8% rent growth. Now their job growth over the last 6 months was slightly negative, basically flat. And then really we've got a lot of other Midwest markets and a couple of Northeast, which that's the theme throughout all the reports, whether it's Yardi, whether it's Real Page, across the board. We're seeing Midwest and Northeastern markets really outperform. In the Sun Belt,
multiple locations
really lagging behind. With the biggest example of Austin. If we go down to like the bottom of this table, again, it's a collection of some of the popular multifamily investment markets that you hear about on LinkedIn so much. But 9.2% of completions of percent of stock for Austin, Texas, that's translating to a negative 5.1% rent growth. And while job growth is relatively it's fine, these job growth metrics, because again, people talk about population growth, and population growth is important. It's a metric, but show you a big chart of population growth metrics and rent growth and returns, and they're not as correlated as you'd want them to be, or those individuals may think. And
job growth, you get a job, you can move out.
Yeah, well, the jobs are the true barometer of economic activity, and it's typically a better leading indicator than just pure population growth.
Yep.
Population growth is typically kind of lagging a little bit of that.
Now it is super interesting to see how the job growth basically. I don't see any number higher than 2.4% right now which is actually Indianapolis. But there are a lot of these places like Austin, 1.6%, and it has 9.2% completions as a percentage of current supply in the past year.
And so we ask ourselves this. I mean, and we do this every day. We've done it for a long time. But I mean, why would I invest in Austin?
Well, so
with negative rent growth
to their
supply.
To their credit, I think that if you look at the job growth 2 years ago, I bet in Austin, it'd be
probably
a huge amount.
No,
but
good point. And they've got a lot of population growth as well. Yeah. There are definitely a lot of jobs, and it's a decent size market. But whether it's, again, when you're looking at employment growth sub 2%, not really kind of breaking out of the national average, you're right in the pack. Why pay a 4 cap in Austin when revenue is growing and you're not necessarily seeing as all the positive economic drivers? Again, just if we're looking on these metrics alone, comparing it to Indianapolis, growing rents at growing employment by 2.5%, rent growth is positive 3.2, and relatively moderate. Completions represent a total stock of 3%. If anything, that 3% rent growth with 3% completions, that shows how much net demand there is, in the face of a decent amount of supply, just not record breaking.
Yeah.
It's an interesting dynamic.
Yeah, I agree, and it's only going to get more complicated and interesting in light of the kind of uncertainty here. I did like this. They have this in their summative paragraphs in the beginning of the report. They say, after years of stability and consistent job growth, the country is getting a dose of new policy that has roiled the financial markets. Some estimates put the number of layoffs in February at more than 170,000, the largest number since the global financial crisis. It's going to get, the market is about to be tested. I think that it's going to be interesting how these policy changes shake out. They're not yet recorded in these investor sentiment surveys that we'll cover in a minute.
Well, that's what we've been talking about a lot, is that there's a lot of sentiment surveys for the first quarter. And were these taken in January, February, or March? At what point in the quarter? Because, January 15th, that there was a much different vibe in the economy than there is of March 15th. Huge difference. Just since, the tariffs, the end of February, beginning of this month, once tariffs became more of a reality and less of a threat, but now it's just the confusion of what it actually may end up being.
Yeah.